The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data.
Rate easing optimism pushing Wall Street to its second week in the green, as the Fed Chair Jerome Powell sets the scene for a September cut, with some traders, yes, apparently there are some traders out there, pondering the possibility of 50 basis point move next time round. Well, it's a more cautious outlook in Europe. The Bank of England Governor Andrew Bailey says it's too early to declare victory over inflation, whilst the ECB's chief economist warns a return to 2% is not yet secure.
The Harris campaign gets a post-convention boost, with fundraising topping $540 million, while Republican vice presidential candidate JD Vance touts the benefits of trade tariffs.
Anything that you lose on the tariff from the perspective of the consumer, you gain in higher wages. So you're ultimately much better off. You have more take-home pay, you have better jobs, and also we have more reliance.
Middle East tensions ramp up between Israel and Hezbollah in the biggest round of strikes between the two since 2006.
Very good morning to you. Good morning, Arabile. How are you?
Good, thank you. Welcome back.
Yeah.
Man, you've missed a lot.
Have I?
I mean, it doesn't look like it anymore, does it?
I go away for 2 days, and within 2 minutes of that, the market collapses and panics, and then I come back, and it's exactly where it was. In fact, it's slightly higher. What was all that nonsense panic going on while I was away?
Who knows, actually. Apparently it was a growth
People not been
scare.
in the market longer than 10 minutes to see a dodgy print on employment, and then they start selling everything inside.
I just wonder what would have happened if the revisions to that had
I wonder
happened
what
the
happens
day
if
after.
I'd been here. It might be a little bit calmer. No, but in all seriousness, I mean, I come away and I've got Mike, the senior producer, putting the headlines together today, telling me there's going to be 50 basis points cut potentially. Yeah. He didn't say. He said the traders are saying potentially in September. I mean, just for all of you out there who've been around longer than 10 minutes, what would the optics say if the Federal Reserve suddenly cuts 50 basis points in September? What would that say about the control that the Federal Reserve apparently exercises over monetary policy and inflation as well? And I say apparently because it's a very loose relationship, despite what a lot of people think as well. It would send out the most extraordinary message that we are behind the curve, that we're getting a little bit panicky now. And what would that do for financial markets in the medium term as well? I find that quite extraordinary. Yes, we may get 50 basis points cuts this year. Yes, we may get 75 basis points. We've got 3 meetings to go. But to go from steady as she goes to, oh my goodness me, we need to go light speed on these rate cuts, that is quite extraordinary. And I saw nothing in Jackson Hole that makes me think otherwise.
No, certainly not. And I mean, when you look at the commentary that just came out of, whether it be Harker, Bostic, Goolsbee that we spoke to as well, all of those kind of give you a clear sense that even from here, it's just about steady as you go. So no need to panic, it seems.
Rate cuts are officially on the agenda, though, for the Federal Reserve after the chair, as we just mentioned, Jerome Powell, said there is good reason to think that the economy will get back to 2% inflation, whilst maintaining a strong labour market. Remember that latter point? It kind of endorses what I'm trying to say. In his closely watched remarks at the Jackson Hole Symposium in Wyoming.
The economy continues to grow at a solid pace, but the inflation and labor market data show an evolving situation. The upside risks to inflation have diminished, and the downside risks to employment have increased. As we highlighted in our last FOMC statement, we are attentive to the risks to both sides of our dual mandate. The time has come for policy to adjust. The direction of travel is clear, and the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks.
And it was pretty much those words then that led to what was a winning day on Friday for Wall Street, which then brought a close to a winning week really overall as well across the board. Then all 3 majors ticking up. Not just ticking up, but more than 1% across the board. The tech sector, again, still showing the leadership in this market then, despite what markets are speaking about with this rotation still in play. But it is still leadership being seen by the mega cap tech stocks then. So you're seeing a significant move higher there, 1.5 higher for the week. The S&P 500 is just within striking distance then as well of its all-time high, having nearly hit that as well just last month. Stocks led up then, of course, by Jay Powell's comments, as we've just been noting. Again, tech stocks being the key ones to look at there. Tesla and Nvidia being the ones that jump more than 4% each, the latter of which, in fact, is set to report its earnings this week. We'll certainly be watching out for that. Overall, on the Treasury front here, Treasury yields dipped then, and this comes after Powell's comments then, and it was really just around saying we're looking towards heading towards 2%. The time has come, as he said there, to look at decreasing rates then. So you saw the 10-year note then dip below 3.8% then, down 2 basis points then as well, while the 2-year note, the more rate-sensitive 2-year note, is at 3.88 here. On the dollar cross front, well, the yen, just very interesting here, is actually now at a 3-week high against the dollar after Powell issued those fairly dovish comments then as well on Friday. It was in contrast, of course, to the Bank of Japan's governor, Kazuo Ueda, on Friday, who also made note that he would be hiking rates if, of course, the data did allow as well. Japanese yen traded just around that 144 mark. It's pretty much its strongest level now since August the 5th, that Nikkei sell-off that we saw, of course, that roiled markets. The dollar, though, near its lowest level in 13 months against the euro, 111.82, significant 132 there against sterling. And on the Asian market front, moving in opposite directions then for a lot of these markets, eyeing now the earnings, of course, of Nvidia, plus Japan's Nikkei losing nearly 1% so far this morning, but still just above that 38,000 point mark, Steve.
Well, but let's get a view from someone I love hearing from, and that's Dr. Naomi Prince, who is founder of Prinsight's Global geo macro economist and former managing director at Goldman Sachs as well. Dr. Prince, Naomi, lovely to see you. Thank you very much indeed for joining us yet again. Look, I don't know if we should be looking at Chicago or Wyoming, but why don't we start off one chat on Wyoming, and I believe we've got you for another chat on Chicago as well. So look, A, thanks for joining us. B, look, you might have heard me ranting earlier on as well, but if the central bank, the Federal Reserve, has got any sense, they're not going to give the market any hint that they're not in control of this thing. You wrote the book on this stuff.
Yeah, exactly. And I was listening closely. They're not going to cut by 50 basis points because, yes, that would make it seem like they don't know what they're doing. It could be argued, given what has happened in the labor market, that they're actually quite behind the curve. I mean, we've seen unemployment tick up from 3.8% to 4.3%, pretty much steady on. It's at 2017 levels. It's not like it's that great. So they have missed a couple things, but they're not going to admit that. We just finally got a CPI print at 2.9%, which I think kind of helped Powell to say the time is now in terms of the inflation and watch. And it's the first time he's brought in the concept of risk or balancing risk so definitively into a statement in terms of what happened at Jackson Hole.
Yeah, look, there's a great argument to say that rates haven't moved but become more restrictive because of what you just mentioned, because of CPI, because of PCE, core PCE, all moving in the right direction, albeit still above the target level as well. If we do get 75 basis points before the end of the year, which is becoming a fairly central scenario for many people out there as well, does that get the Fed back on track?
I think it does, and I think we do get 75 basis points in this 25 basis point per meeting dribble because they do have to get back on track. They are behind on the labor curve, and they can't actually control inflation. I mean, yes, we have seen this decline of inflation coincidentally, throughout the entire period. They have been raising rates and then staying put on rates, but the reality is some of that is also cyclical. We had pop-ups, after COVID, we had a kind of decline after that. A supply chain somewhat normalized, and this has all been happening at the same time. So I think they've been behind on the labor market. They were sort of hopeful on inflation getting at least a 2% handle, which is somewhat arbitrary anyway. I mean, that is the 1977 sort of benchmark concept, but we're all using it. And that's where we are right now. And then I do think they get back on track and sort of even.
Yeah, Dr. Nomi, I mean, one thing I wonder then is that unemployment rate. When do they begin to worry, do you think? 4.3 right now. Is 4.5 beginning to be a worry, or would it be 5% where you begin to fear?
That's a really good question. The fact that it's got to 4.3% so quickly, when just a few months ago, Powell and basically the rest of the FOMC was talking about this hot labor market. It wasn't that long ago, and since then we've seen this increase in unemployment. And I do think you start to get to 4.5%, they should worry. You get to 5%, they should really worry. But it's very possible we get to 4.5, 4.6% before the end of the year.
And then there's the other part of consumer spend here, right? I mean, will the consumer spend enough to still keep that soft landing in play, or is it all just going to be about the jobs print from here?
The consumer has been strong in terms of spending, and even that pop-up that the U.S. had in GDP last quarter to 2.8% after a decline to 1.3% from 1.6% in quarter one had a lot to do with the consumer, but also it had a lot to do with consumer debt. We are looking at over $17 trillion of record in household debt. We are looking at increasing delinquencies across all the credit spectrum. So that's cards, that's autos, that's mortgages, and we're looking at increasing default. So though the consumer is sort of buoying somewhat these GDP figures, the reality is the consumer is quite stretched with respect to debt, as is the country. And that's going to come into play, particularly if the unemployment situation gets worse and there's more fear, more risk with respect to the labor market.
I mean, you're one of those few people I've ever met in my life who A, has the time to write financial books and B, make them readable as well, which is a dual skill. I'm a big fan of collusion, as you know. I'll park that one for now. Permanent distortion. The reason why I want to mention it, I know you've had it out a couple of years now, but because it's all about how the markets and about how they are divorced from the real economy. Well, look, they've even got a slate for it. It's up there on the screen. How divorced are the financial markets from the real economy at the moment? I know that's a huge question, but I ask that because it's nuanced. You've got many, many classes of stock, of course, as well, many, many classes of financial markets, but you've got a lot of stocks out there that are trading at a significant discount to a certain number of very excitable stocks, shall we say, as well. So there are two markets out there. I just wondered what the distortion looks like to you a couple of years after going into print.
Yeah, it's interesting because when the book first went into print, that was when we were in a higher inflation point. And it was said about the book, well, the Fed's going to take care of it. It's going to be fine. Inflation's going to come down. Rates are going to go up. We'll be in a different period. And permanent distortion, which is basically this idea of excess monetary policy, printing money, QE, and everything else won't have as much meaning. Well, we are still at a $7 trillion book of assets with respect to the Fed. That's down from $9 trillion, but it's still higher than the $4.5 trillion that it was in the wake of the financial crisis. So there's an awful lot of cushion to the financial industry that the Fed still has on tap. The stock market, the bigger names have rallied because they have had more of this sort of influx, whether it's pension funds, asset management funds, ETFs, and so forth, have basically funneled some of this money, a lot of this money into the markets. And that's why even though the Fed has been raising rates during this period from March 2022, stopping last year and keeping them where they are, the stock market, with the exception of these like crazy days, like the freak out that happened after the FOMC meeting minutes came out last week, which was then calmed by the Jackson Hole speech by Powell, and then the market went back up. For the most part, the market's been trending up. And what that shows is that the money that has been effectively created by the Federal Reserve for the banking system and that goes on into the rest of the financial markets continues to be on tap, even though we are in this tightening phase, which we're about to basically get out of.
Yeah, and we haven't even talked about AI, where there was a great headline in The Economist the other day, artificial intelligence losing hype. Nomi, we're going to leave it there for the moment. Thank you very much indeed for your insights. I know you're going to spend some more time with us in a few moments' time talking about the politics, which I can't wait for as well. Thank you very much indeed for that. In the meantime, I was looking at the Jackson Hole. I thought they were just desperate. All the scribes who spend thousands of pounds on their airfares getting to Wyoming, the most beautiful place. I think they were desperate for headlines. Yeah. And I've got to be honest, if you'd looked at my interview with the Bank of England Governor Andrew Bailey, you probably wouldn't have needed to send a journalist all the way there to get the following. The Bank of England Governor Andrew Bailey told Jackson Hole Conference, yes, it's too early to declare a victory on inflation. Gotta be honest, said it at the interview. Anyway, despite being cautiously optimistic, heard that before, this after the Bank of England made its first rate cut in more than 4 years earlier this month. I was there. After consumer price inflation briefly returned to the 2% target before ticking higher again in July. Money markets currently see the central bank holding rates ahead of another cut in November. Elsewhere, the ECB chief economist Philip Lane, he struck a pretty cautious note, telling attendees that whilst the central bank is making good progress on cutting inflation, success is not yet assured. Sounds familiar, meaning that restrictive policy still has a role to play. The ECB is expected to make a second rate cut next month, taking its base rate to 3.5%.
Now, coming up on the show, former U.S. President Donald Trump steps up his efforts to combat post-DNC momentum from the Harris campaign. We'll bring you the latest on that next. Plus, Israel declares a 48-hour state of emergency after carrying out preemptive attacks on Hezbollah sites. We'll bring you more later this hour. And French President Emmanuel Macron convenes talks with party leaders in a bid to form a new government. We'll discuss more then with Nathalie Oziel, the Member of Parliament for the NFP coalition. Tune into that interview at 9:30 CET.
CNBC Connect is back in Bangkok, Thailand. Join the world's top entrepreneurs and C-suite executives for an invite-only leadership retreat. On the agenda, powering innovation and growth in Asia. Is AI transforming industries and creating opportunities? And get insights on building sustainable and resilient businesses. Be part of Managing Asia Live. Network and join an interactive brainstorm session. CNBC Connect, powering innovation and growth in Asia on September 4. Register now.
Now, Kamala Harris's presidential campaign says it has raised $540 million from donors since President Biden ended his campaign and endorsed Harris in late July. Campaign manager Jen O'Malley Dillon said in a memo that $84 million was received in the week of the Democratic National Convention. This as Harris and vice presidential candidate Tim Walz focused their campaign, on attention on Georgia, kicking off a bus tour in the crucial southern swing state later this week. Now, Donald Trump's campaign is also expected to ramp up this week, with campaign stops scheduled in the key Rust Belt states of Pennsylvania, Michigan, and Wisconsin. Republican vice presidential candidate JD Vance joined NBC's Meet the Press this weekend, defending Trump's proposal for blanket tariffs on all imports into the U.S.
I think economists really disagree about the effects of tariffs because there can be a dynamic effect, right? So what some economists will say is what you just said, that it will actually raise costs for consumers. But what other people say, and I think the record supports what this other view, is that it causes this dynamic effect where more jobs come into the country. Anything that you lose on the tariff from the perspective of the consumer, you gain in higher wages. So you're ultimately much better off. You have more take-home pay, you have better jobs, and also we have more reliance. Because one of the things we learned during COVID, I don't, by the way, blame Democrats for this, but one of the things we learned during COVID, Kristen, is that if our supply chains are really brittle, if we depend on the Chinese to make too much of our stuff, then prices can skyrocket at a time of crisis. The economists who say that tariffs are bad, they don't take that into account. And we've all learned it the hard way.
Wow, there was a politician talking about issues. Dr. Naomi Prince is with us, author of Permanent Distortion, founder of Prince Sites Global. And I say that, Naomi, and lovely to see you again after the break, because I've heard too much about JD Vance, about Tim Walz, about Kamala Harris and Donald Trump, just slagging each other off, for want of a better word. Actually, there was JD Vance doing what Americans want them to do, which is talk about the issues. It was refreshing.
Yeah, it is good to talk about the issues, and the issues of tariffs is interesting in and of itself because both the former Trump administration, the current Biden-Harris administration, and whoever is going to be in office, come next year, are all basically on the same page with tariffs. They say different things sort of publicly, but there are two sides. On the one hand, tariffs, yes, they can impact the consumer, and they do. On the other hand, it's true that controlling a nation controlling more of its own supply chain on the long haul is actually better in terms of prices. So there are two sides to that, and it is good to be able to discuss both of those.
Yeah, and we can be completely apolitical about this. It doesn't matter whether you're from the right or the centre or centre left. Actually, just hearing the issues being debated, it's refreshing for all of us. So look, we're coming on the back of the DNC. Chicago was It was very interesting. It was a parade, wasn't it? From Oprah to the Clintons to the Obamas to the president himself and, of course, Kamala Harris as well. It was very well orchestrated. But what did we learn from it, Naomi?
Yes, it was very well orchestrated. The major events obviously were very fanfare-y. There was a lot of events that took place around the United Center as well, with all the state delegates, the governors, the senators, the congresspeople, all basically gathering to talk, yes, about their candidates, but also about some of the issues, infrastructure, energy policy, climate policy, and so forth. So in terms of what we learned about those particular policies on the main stage, not a ton. Some of the economic policy that we did hear about, of course, higher tax credits for children, higher taxes for corporations from 21% to 28%. So there were some specifics in terms of the economic policy, but a lot of those conversations were actually happening outside of the main hall.
Yeah, Naomi, I mean, one of the things one might ask, and I've certainly been asking, is how do you turn this momentum then into actual support and actual votes in the end of all of this? Because now you've ratcheted up $540 million as Kamala Harris and the campaign, but now making it into a viable election plan for the next 70 odd days is probably the more important and critical part, isn't it?
Well, exactly. And if we just focus, for example, on the economic side, which is of concern to many Americans, inflation, prices, affordability, and so forth, there has to be an argument made from the Harris campaign, also from the Trump campaign, to go out into middle America, to those battleground states, to those swing states, and to meet with workers, to meet with ordinary people who are actually still concerned about the nature and the stretch of their own sort of personal economies. And that's going to be where this race is going to take place. That's going to be where the bulk of that, 540 whatever million dollars is going to be spent. It's going to be spent in those states, in Pennsylvania, North Carolina, and Georgia, in order to get those marginal voters or the sort of independent voters in between parties to basically sign up. And that's where we're going to see a lot of power, not just from the main candidates, but also from those state individuals as well, state senators, governors, and so forth. What was evident at the DNC in Chicago was there's a major singing from the same songbook with respect to all of the power people and the party sort of being a part of the campaign. And they're bringing that campaign to basically middle America and some of the southern states that are in play.
I mean, in such a tight race, there's also one spanner in the works here, and that's Robert F. Kennedy Jr., particularly in swing states. How do you see that impacting things?
Well, it's interesting. Of course, he's now associated with the Trump campaign, and I think that does bring some of those voters in those swing states that he did capture, and that was sort of loosening over time. Some of those numbers were actually declining with respect to his support, but the support that he does have, it's probably more likely it's going to help the Trump campaign, which is why that happened, than it would have helped the Harris campaign, which is why that also didn't happen. And that can be a factor in some of the battleground states, but also he's not really that sort of supported by the labor movements, by the workers, by the unions, and so forth. And those are going to be part of the battles that are going to be fought in those states.
I mean, there's one battle that neither of them really want to fight, and whether they're Democrat or Republican, that's the battle against excessive debt in the United States. When I look at the CBO projections for 2030 out to 2050, I hide. I'm going to go into, I don't care if they're Democrat or Republican. They look blooming awful. So can the US afford either of these candidates' proposals, making individual income tax cuts permanent or expanding child tax credit? They all sound great, and they're all kind of pro different parts of the economy and making things a bit easier. But can the US afford either of these sets of policies for the next few years?
Yeah, zero candidate has been talking about the 35.2 and counting trillion dollars worth of debt, or the fact that the United States spends nearly $1 trillion at the moment, $956 billion a year on just servicing its debt. So before it turns the lights on in Washington, it's basically paying off a significant portion of debt. Of course, that's gotten more expensive with the Fed having hike rates and so forth. But what that means is growth policies actually don't happen until that $1 trillion gets paid out every year, and that's a problem. So if you start to reduce taxes, whether it's to corporations or whether it's in the form of giving credits, they both have their positives and negatives, but neither of them really impacts reducing that debt. What would impact reducing that debt is a policy to actually grow the economy, which neither party really has been specific about.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.